Okay, so thank you for hanging in with me. I know that last video was really long, but this video will be shorter, I promise. Uh, so we're going to wrap up. We've now done all of what are called the operating budgets, and we're going to wrap up by doing the cash budget and then the budgeted financial statement. So the financial statements, we have the budgeted income statement, a budgeted balance sheet, and a budgeted statement of cash flows. But before we can do that, we're going to look at what's called the cash budget. So the cash budget and the budgeted statement of cash flows are not the same thing. The budgeted statement of cash flows looks like your GAAP formatted statement of cash flows, with cash flows divided by operating, investing, and financing activities. We're going to look at a cash budget, which is going to show us how much cash we expect to receive and when we're going to receive it. So we focus on the timing of the cash flow, not just how much cash we're receiving, and then how much cash we're expecting to pay, and the timing again of paying that cash flow, so that we can see when we might run short of cash and when we would have an excess of cash. So the cash budget's really, again, going to pull from all of those other budgets that we've done. So ideally, you're sitting at a big table, and I realize it may not be ideal circumstances, but maybe you have all of your budgets laid out there that you've filled out, and you can pull from them and flip back and forth through them and find those numbers. So again, it's really important that you know where all of the numbers come from. If you have a problem finding a number, pause the video, go try to find it, or post a message to the message board. So the cash budget is broken into three sections: cash receipts, cash payments, and then a short-term financing section if necessary. So we're going to start with the cash receipts section. So out of our cash receipts, for example, in quarter one, we look at our sales. We expected sales based on the sales budget to be $250,000 in quarter one. Out of that $250,000, we're told that we expect 30% of those to be cash sales. So cash sales are received at the time of sale. So 30% of that $250,000 is going to be received immediately. But the other 70% will be sales on account. So people will buy from us and they'll say, hey, send me a bill, I'll pay you later. We'll have an account receivable. So of those account receivables, we expect to collect 60% of those in the quarter of sale. So you can think of it this way: the people who buy in January will probably pay us in February. The people who buy in February will probably pay us in March. But the people who buy in March won't pay until April. So those 40% of those account receivables won't be collected until the following quarter, in this case quarter two. Now we're told bad debt is not significant, so we're not expecting to have to account for how much we may not receive. And if you flip back to that balance sheet that we looked at the very beginning of the video, we'll see accounts receivable was $70,000. We expect to collect that in quarter one of this year. So these are the people that bought in the end of November, December of last year are going to pay us in probably January of this year. All right, so let's walk through this. I'm going to walk through quarter one and two with you, and then leave you to do quarter two and three like we've done before. So first quarter, I'm going to start out up here by putting down our sales number. So I'm just copying these straight off of the sales budget. So remember, in quarter one, we expected sales to be $250,000. We expected it to be $275,000 in quarter two, $300,000 in quarter three, and $325,000 in quarter four. So again, hopefully you've got that sales budget pulled up there and you've got all those numbers pulled right there in front of you. All right, so now what we expect to pay, or to receive, sorry, my apologies. So the first thing we expect to receive are our cash sales. So remember, our cash sales are 30% of sales for the quarter. So in quarter one, we expect our cash sales to be 30% of $250,000. So I'm going to try to write, and again, I apologize, my handwriting is never good, but it's especially bad on this tablet, how we calculate these numbers, okay? So 30% is 0.30 times $250,000 is going to give us what our cash sales are. So out of the $250,000 of sales for quarter one, we expect 30% of those, or $75,000, to be in cash. Now, if total sales are $250,000 and cash sales are 75, then that means credit sales, or sales on account, would be 175,000. So I just subtracted that to say total sales are 250. If cash sales are 75, then 175,000 is our credit sales. Okay. So of those 175,000 of credit sales, we expect to receive 60% in the same quarter of sale. So I'm going to label that credit sales, and that's 60%, but it's 60% of the credit sales. So in this case, that would be 60% of the 175, the credit sales. So 60% of 175,000 is $105,000. Okay. Now the other 40% of that 175,000 is going to be collected in quarter two. So I'm going to go over here to quarter two, and I'm going to plug this down here. This would be my accounts receivable, which is 40%. So this is the 40% of the 175. So it's from here. So that 40% of the 175 is 70,000. So of my $250,000 of sales in quarter one, 75,000 are in cash. I'm going to collect that in quarter one. 175 is on account. Of the 175 that's on account, 105 I'm going to collect in quarter one. The other 70 will be collected in quarter two. So remember, for quarter one, though, I am collecting my accounts receivable. In quarter one, that comes off the balance sheet. So I'm going to write balance sheet here, and that was $70,000. Now, the fact that that was $70,000 and your quarter two is $70,000 is just a coincidence. Please don't think that they're always the same. They're not. So in quarter one, I expect to collect a total of $250,000. Now, again, the fact that that is the same as the sales in quarter one, just a coincidence, okay? Don't think that it's always going to be that way. So this is total cash collected. So let's look at quarter two. Quarter two sales were $275,000. I expect cash sales to be 30% of that. So 30% of 275 is $82,500. Hopefully you've got your calculator with you and you're calculating this with me. So if total sales are $275,000 and cash sales are $82,500, that means my credit sales for quarter two are $192,500. I just subtracted those two numbers. Okay, so I said 275 minus the 82.5 gives me my credit sales of 192,500. Of that 192,500, I expect to collect 60% in quarter two. So 60% of 192,500 is 115,500. Okay. Now the other 40% of this 192,500 will be collected in quarter three. So I'm plugging this in my calculator here as we go along. So that means 77,000 will be collected of quarter two sales in quarter three. So quarter two sales, if I total them up, I've got my 82.5 of cash sales, I've got my 115.5 of credit sales collected in quarter two, and then I have my accounts receivable, the 70,000 of quarter one sales that I'm collecting in quarter two, and I expect to collect $268,000 in quarter two. So I'll let you pause the video, go through, calculate quarter three and quarter four, and then the total, and then we'll move on to the next slide. So let's check our answers. This one's structured a little bit differently, but not really. It's all the same numbers there. So if we look at quarter three, our cash sales are 30% of the quarter three sales, or 90,000. So that leaves 210,000 of credit sales. Of those credit sales, 60% are collected in the quarter of sales, so that's the 126. The other 40% will be collected in quarter four. So so then total of quarter three is quarter three's cash sales, quarter three's 60% of credit sales, and then quarter two's 40% of credit sales, for a total of 293. So now let's look at quarter four. We expect cash sales to be 30% of the 325,000 of total sales, or 97.5. Of the credit sales, so if total sales are 325 and the cash sales are 97.5, then our credit sales are 227,500. 60% of those will be collected in quarter four. The other 40% will be collected in the following year, in 2028. So quarter four is collecting quarter four's cash sales, 60% of quarter four's credit sales, and then 40% of quarter three's credit sales, for a total of 318. Now, the 40% of quarter four's credit sales that aren't collected until next year, those are what we would call accounts receivable. So down here, remember, quarter four's credit sales are 227,500. 40% of that is 91,000. So this 91,000 is our accounts receivable. So when we get to our budgeted balance sheet, this is the amount of quarter four sales that we expect to collect in the following year. So we'll put this on our balance sheet as accounts receivable. So now that we know how much money we'll have coming in, and we have a better idea of when it is coming in, now we can do our schedule of cash payments. So we're looking at when are we going to have to spend money, how much are we going to have to spend, and making sure that the timing lines up. So typically we have to spend money on kind of three big things. Certainly we have to pay for our product cost, materials, labor, and overhead. We have to pay for our selling and administrative expenses, and we might have to pay for capital expenditures. So capital expenditures, and notice this is capital with an AL, not an OL like Austin and Washington, D.C. Capital expenditures are when we're going to buy a large piece of equipment or engage in a large company expansion. These are things that are going to take a lot of money. We talked about these a little bit in that strategic planning at the beginning of the chapter, and we'll pick up and talk about them a whole lot more in chapter 11. So for right now, just know this is when I'm going to buy something really big, a piece of equipment, a car, a piece of land, a new building, something like that, and I've got to plan for how I'm going to pay for that. So in our problem, we're told that we plan to purchase some additional equipment. We're going to buy it in 4 equal installments, and the total cost is $160,000. So $160,000 divided over 4 equal installments would be $40,000 per quarter. Now, we know we have to pay for materials. All materials are purchased on account. This is pretty much the norm. I've got accounts with my suppliers. I buy the materials. They send me a bill. I pay them later. So we have a track record of paying 75% of our purchases in the quarter purchased. So in other words, the stuff we buy in January we'll pay for in March. Excuse me, in February. The stuff we buy in February we'll pay for in March. But the stuff we buy in March we don't pay for until April, until quarter two. So 25% of what we purchase in the quarter won't be paid for until quarter two. If you flip all the way back to the beginning to that balance sheet, you'll see that we have a $20,000 balance in accounts payable. That's money that we owe from last year for materials, so the stuff we probably bought in end of November, December that we now have to pay in this quarter. Everything else is paid for in the quarter incurred. So labor, overhead, those sorts of things are paid in the quarter incurred. We also have to make quarterly tax payments, and again, that's very normal. Most companies will make quarterly tax payments. Our tax payments are expected to be $70,000 paid in 4 quarterly installments. So $70,000 divided by 4 quarters is $17,500 per quarter. So let's get in here and figure this out. So if you will flip back to your direct materials purchases budget, we can see that in quarter one, our purchases for direct materials were $65,100. Of that $65,100, we're expecting to pay 75% of that in the first quarter. So again, I'm going to try to write very small here. So I'm going to say 75% of the 65,100 that I'm paying in quarter one. So if I've done my math correctly, that's 48,825. And then the other 25% of quarter one's materials purchases will be paid for in quarter two. So I'm going to write this over here in quarter two. So again, if I've done my math right, 25% of 65,100 is 16,275. Now remember, I also have to pay that $20,000 in materials from last year, and remember that's accounts payable, so I'm going to go ahead and write that in here. So I'm going to pay that $20,000 from last year. Now, if I go look at my direct labor budget, I see that direct labor is $30,750. I'm just going to pull that straight off of the direct labor budget. So that was $30,750, and I'm going to write over here, this is direct labor budget. Now, when I go look at the overhead budget, this is really important. When you look at your overhead budget, you'll notice, and I'm flipping back there as well to look at my notes. I see that total overhead for quarter one is $35,640. However, out of that $35,640, $12,000 of that is for depreciation. Remember, depreciation is a non-cash expense. You don't actually write a check to anybody for that. So when I'm doing my cash budget, I want to take that $12,000 out. I'm not going to include that $12,000 because I'm not really paying that to anybody. So that means out of the $35,640, I'm only going to have to pay $23,640. So for overhead, the amount of cash I'm going to spend is $23,640. The same thing for the selling and administrative expenses. Again, if you flip back to your selling and administrative expense budget, we see that in quarter one, total selling and administrative expenses are $61,500. But $1,500 of that is for depreciation. We don't actually have to pay anybody for depreciation. So I'm going to include that. I'm going to take that out. So for selling and administrative expenses, it's just going to be $60,000. So make sure that you subtract those out, subtract the depreciation out. Now the taxes we are told are $70,000 per for the year, so divided into 4 is $17,500. And the capital expenditure we're told is $160,000 for the year, so again divided into 4 makes that $40,000. So I'm just going to go right up here. This is the overhead budget, and this is the selling and administrative budget. So those numbers come straight off of those budgets. So now when I total this up for quarter one, I'm going to add all of my cash payments up, and if I did the math correctly, I get that I'm going to spend $240,715. Now, if you look at your schedule of cash receipts, remember we're only expecting to receive cash of 215. So, granted, that's more than what we expect to pay, but not a lot more. It doesn't give us a lot of cushion. So, we'll address that when we put all of this together in the cash budget. So then let's do the second quarter together. And then again, I'll have you finish quarter 3 and 4 on your own. So if I look at direct materials for the second quarter, according to my direct materials budget, direct materials purchases were 87,000. So 75% of that 87,000 I'm going to pay in quarter 2. So 75% of 87,000 I believe is 65,250. Now, the other 25% of quarter 2's materials purchases will be paid for in quarter 3. So I'm going to go ahead and fill that column in. And I believe that 25% of 87,000 is 21,750. So I know that in addition to quarter 2's materials purchases, I have to pay the other 25% of quarter 1's material purchases, which I already have in there. When I look at my direct labor budget, I see that labor for quarter 2 is expected to be $42,000. When I look at my overhead budget, I see that overhead for quarter 2 is 38,640, but I'm going to subtract out that 12,000 of depreciation costs, so that leaves me 26,640. My selling and administrative expense budget is 61,750, but when I subtract out that 1,500 of depreciation, that leaves me just 60,250. Then my taxes are still 17,500, and my capital expenditure is still 40. And so when I add all that up, I get total cash expenditures for the second quarter of 267,915. So now I'm going to ask you to pause the video, go ahead, try quarters 3 and 4 in the total, and then restart the video and we'll go over the rest of it together and check your answer. So hopefully your answers look like mine. Now, the one thing that we still need to address is our quarter four. We know we paid for 75% of the direct materials purchases in quarter four, so that's 75% of the 102,000. But the other 25% of quarter four's materials purchases won't be paid for until next year. So that will show up in our balance sheet as accounts payable. So I'm just going to write this up here at the top. My accounts payable balance is going to be equal to 25% of quarter four's materials purchases, which is $102,000. So 25% of $102,000 is $25,500. So when I do my budgeted balance sheet in a minute, I want to make sure that I include the accounts payable, which is the quarter four materials purchases that won't be paid for until quarter one of next year. So if you're wanting a little bit neater diagram to look at, you can look at this one that comes out of the textbook. It's got all of the same data that we have, but ours is a little bit condensed and this one's a little bit neater to review. So now that we've got our cash receipts and our cash payments, we need to put them together in what's called the cash budget. So the cash budget is really looking at the timing of the cash receipts versus the cash payments. So as we do this, we know that we want to maintain some minimum cash balance, and how much you want to maintain is a personal decision between you and your business. I always give the example of, I always tell my kids they need to have a $20 bill in cash on them all the time. That way, if they're somewhere and I don't know, their card doesn't work or whatever, they have some money on hand. Just whatever you think your minimum cash balance needs to be. So for this company, their minimum cash balance is $30,000. So if we're not going to maintain $30,000 cash, we want to make sure that we have access to maintain $30,000 cash. So like most businesses, we have a line of credit with our bank, and we can pull down and borrow from the bank as we need to. Borrowings have to be made in increments of $1,000. Now, I realize that seems like an arbitrary rule, but it helps our calculations, keeps those easier. So we're going to go with that scenario. We're going to repay those then in months that we have more money. We'll repay that back. Similar, just like you would use a credit card on months that you're short on cash, you'll use your credit card, you'll pay it back the next month. Our payments are interest. We have to pay back in increments of 1,000 also, and we have to pay interest equal to 3% per quarter, which for the record would be 12% annually. So this is a 12% APR. So last year, again, if you look on the balance sheet, you'll see that the ending cash balance was $15,000. So apparently last year, our minimum cash was lower than this year, but we felt that we needed to raise that. So now let's go pull off our numbers here and look. So this beginning cash balance is going to come straight off of the balance sheet for quarter one. So I'm just going to kind of put a BS there in the corner. So we know that for quarter one, we were just told that our beginning cash balance is $15,000. That's how much we're starting with. Now, our cash receipts are coming straight off the schedule of cash receipts, right? So if you go pull up your schedule of cash receipts that we just did earlier in this video, we can see that for quarter one, our expected cash receipts are $250,000. So that means we expect to have $265,000 of cash available. Now we just calculated our cash payments, so flip back and look at that schedule of cash payments, and we see that our cash payments for quarter one were $247.15. Now I want to put this in parentheses because I want to subtract this. So when I subtract my cash available minus my cash payments, I get an ending cash balance of $24,285. Now, that's a pretty good balance, but remember our minimum cash was $30,000. We want to maintain minimum of $30,000 of cash on hand. Since we don't have $30,000 of cash on hand, we're going to need to borrow. So my minimum cash is 30. I'm going to treat that as a negative. I'm going to put it in parentheses here because I'm essentially saying, hey, I want to pull out $30,000 and keep to the side. Now, how much money do I have? Well, when I pull out that minimum cash balance of 30, now I have what we call a deficiency in cash, meaning it's not enough, okay? I have a negative balance of 57.15. So even though I have a positive cash balance, it's not high enough. So I'm going to have to borrow some money. Now, in order to get us above $30,000 and keeping in mind that we have that restriction that we have to borrow in increments of 1,000, I'm going to borrow $6,000. So $6,000 will get me over that 30,000 minimum and give me meet the requirement of borrowing in 1,000. So now my ending cash balance, and this gets a little bit tricky, so pay attention to me here. My ending cash balance is the ending cash before financing plus the financing. So these two numbers added together are going to give me my ending cash. So if I had 24,285 and I borrowed 6,000 on my line of credit, that would give me an ending cash balance of 30,285. So now let's do the second quarter together. So for the second quarter, my beginning cash now becomes the 30,285 from quarter one. So quarter one's ending becomes quarter two's beginning. So I'm going to pull that 30,285 up here. My hand keeps touching the screen, and so all right, so then I go back to my schedule of cash receipts and I see that my expected cash receipts for quarter two were 268,000. So that gives me cash available of 298,285. Now I'm going to go to my schedule of cash payments now and pull out my schedule of cash payments. I expect to have to spend, sorry, I have to flip back and get mine. $267,915, I believe, was our number. So when I subtract that out, 298,285 minus the 267,915, I get that I'm going to have ending cash before financing of 30,370. So the good news is that I'm over that minimum threshold of $30,000. So I don't have to borrow any money. I have an extra $370. Now, I don't have enough extra money to actually pay back the $6,000 that I borrowed, but I can start paying the interest on that $6,000. Remember, the interest is 3% per quarter or 12% per year, however you want to calculate that. So let's do the interest calculation up here at the top. I'm going to write this up here. So my quarter two interest, remember our formula for interest is principal equals rate times time, and the time function has to be expressed in the same terms as the rate. So if I have a quarterly interest rate, then I can use quarters for time. If I'm using an annual interest rate, I have to use annual for time. Since I have a quarterly interest rate, I can just use quarters. So my principal was 6,000. My interest rate is 3% per quarter, and I can, again, since my interest rate is quarterly, I can use time in terms of a quarter. So only one quarter has passed since I borrowed this money. So that means the interest that I owe thus far is $180. So I want to go ahead and pay that $180. So that would give me, so I'm going to subtract that out. So that would give me as my ending cash the 30,370 minus the 180 of interest that I'm paying back, or 30,190. Now, if you want to go ahead and pause this, try quarter 3 and 4 on your own. I'm going to keep talking and keep working through it. So pause it, try it, and then come back and I'm going to walk you through all of this. So for quarter 3, my beginning cash balance is $30,190. My cash receipts from my schedule of cash receipts are $293. So that gives me total cash available of $323,190. Now, according to my schedule of cash payments, my cash payments in quarter 3 were $284.15. So that gives me ending cash before financing of $39,175. So this is fantastic. I now have enough extra cash that I can pay off the $6,000 that I owe, plus I have to pay that extra interest that I owe. So remember, the interest is $180 a quarter. I've now had it for another quarter. So I'm going to pay back all $6,000 that I owe. Oh, sorry, I didn't do my excess cash of $91.75. So now I'm going to pay back the $6,000 that I owe, plus I'm going to pay back quarter 3's interest. So quarter 3's interest is calculated just like quarter 2's. It's 6,000 times 3% times 1 quarter, because 1 quarter has passed since we last paid interest. So that's still 180. So I'm going to pay back the principal of 6,000 plus the 180 of interest that has accrued since quarter 2. So that means my ending cash is the $91.75 minus the $61.80, or $29.95, plus the $39,175. Or in this case, so excuse me, I said that incorrectly. My ending cash is the $39,175 minus the $61.80 that I just paid back to the bank. So that leaves me with $32,995. So now I move into quarter 4. So my beginning balance with quarter 4 is $32,995. When I look at my schedule of cash receipts, my cash receipts are $318 for quarter 4. So that leaves me with total cash available of $350,995. Now, looking at my schedule of cash payments, my total cash payments are $296,515, which leaves me ending cash before financing of $54,480. Now, I subtract out my $30,000 minimum cash. I have plenty of excess cash. I definitely don't have to borrow. I've got $24,480. I've already paid off everything that I borrowed, so there's no financing. So my ending cash balance is just the $54,480. So when we look at the total columns, we can figure these out really quickly. My total, remember the total is the year-end total. So my beginning cash for the year was $15,000. My total cash receipts are $1,129,000. That gives me total cash available of $1,144,000. My total cash payments were $1,089,250. My ending balance before financing is, remember, the year in review. So the ending balance is the balance at the end of the $54,480. My minimum cash balance is always the 30,000. It doesn't get added up. So that leaves me with my excess cash at the end of the year of 24,480. And then I wind up with my financing at the end is 0 and my ending cash is the 54,480. So again, if you're unsure where any of those numbers come from, make sure you go back and find them, post a message to the message board. The tricky thing, the thing that we forget is that our ending cash is the ending cash before financing plus or minus any of our financing, and that gives us our ending cash. So again, here's another look at the cash budget, walking you through step by step. There's one little difference between what I did and what they did here. Either way is correct. I just chose to do it a little bit differently. So when we look now at this slide, you'll notice that they included the interest expense up here as opposed to down here in the financing. I like to include the interest down in the financing. They like to include it up with your cash payments. Either way is acceptable. I just chose to do it a little bit differently. In my accounting lab, you'll do it however they have it set up. Now, I just want to point out as we get to the end here, because this is going to become important in a minute, that in total, we paid $360 in interest. That was $180 that we paid in quarter one, plus the in quarter two, plus the $180 that we paid in quarter three. That will become important in a moment. So now we're ready to look at our budgeted financial statements. These budgeted financial statements are the exact same financial statements that we learned in financial accounting. They're just prepared using budgeted numbers instead of historical numbers. So we're literally going through all of our budgets and pulling the numbers out of the total column because the income statement is for the entire year. So the net sales revenue, this came out of the sales budget. We just pulled total revenue off of the sales budget. Cost of goods sold, this came directly off of the cost of goods sold budget. So net sales revenue minus cost of goods sold gives us gross profit. That's just a subtotal. Selling and administrative expenses, this came directly off the selling and administrative expense budget. So then again, gross profit minus selling and administrative gives us operating expenses. Then we have our other items. We didn't have any revenue or gains this year. We didn't sell any equipment. We didn't have any interest revenue, but we did have interest expense from the cash budget. So this 360 came right here off of the cash budget. That gives us income before taxes. Then we have our tax expense of $70,000. Again, that came off of the cash budget as well, or the cash payments budget actually. And then we get our budgeted net income. So from here, we could do a budgeted statement of retained earnings. We'll definitely look at our budgeted balance sheet. So our ending balance in cash, this 54,480, this came straight off the cash budget. The accounts receivable came off the schedule of cash receipts. The raw materials inventory, this came off of the direct materials purchases budget. The finished goods inventory, this number came directly off of the production budget. So if you look at your production budget, it said ending inventory was going to be 140 units. And we know based off the cost of goods sold budget that each unit has a cost of $294. So 140 times 294 is how we get that finished goods inventory. So that's really production budget and cost of goods sold budget. So our equipment was last year's equipment plus the new equipment that we bought. So that came off of the old balance sheet and the cash budget. That our accumulated depreciation was last year's depreciation plus the depreciation from the overhead budget plus the depreciation from the selling and administrative expense budget. So this gives us total assets of $533,580. If we look at our liabilities, our accounts payable came straight off the cash payments budget. Common stock didn't change from last year to this year, so that was straight off the old balance sheet. The retained earnings was last year's retained earnings plus net income that came off of the income statement. And so we get total stockholders' equity and then total liabilities and stockholders' equity. So I know that this chapter can be especially confusing. It's a lot of numbers. It gets very difficult. It's a lot of information. These videos are long. Please don't get discouraged. Just take it one budget at a time. Work through it. Work through the My Accounting Lab. Again, one problem at a time. As always, I encourage you to work it out on paper and then check your answers in My Accounting Lab. And if you make a mistake, you can catch it and fix it. But don't let this discourage you. This is a hard chapter, but you can do it.